Explain what a cost seg is, like we're dummies.
So cost segregation really is just accelerated depreciation on your real estate assets. So one of the benefits of owning real estate is you get to take what they call depreciation, which is an expense against your income every year. So when you buy a residential property, let's say a a long-term rental or an apartment building, anywhere where somebody lives, those get depreciated over 27 and a half years. So if I buy a fourplex, let's just say to make the math easy, I buy a fourplex for $275,000. I basically take 275 divided by 27 and a half, which equals $10,000 a year as a write-off. So I get a $10,000 expense every year as a write-off. It's a non-cash expense, but it does come off of my taxable income. So if let's say I make $100,000 a year, instead of me paying tax on $100,000, I've got this $10,000 write-off. I'm now only paying tax on $90,000. That's kind of how depreciation works. So that's called straight line depreciation. And again, for residential units, it's 27 and a half years. Any commercial unit, it's 39 years. So office buildings, medical space, restaurants, etc. So that's called straight line depreciation. That's what a lot of people do. They get a closing statement, they hand a closing statement to their tax preparer, and they just do that easy math, take it divided by the number of years. Cost segregation is, I want my deductions at a much faster rate. I'm probably not going to own my property 27 and a half years from now. And inflation and time value of money, I want all of my deductions now if possible. Well, we can't get all of them now, but we can certainly front load a bunch of them into these early years by doing cost segregation. And what cost segregation is just an engineering-based study where we go into the property, and just as the name implies, we segregate the cost into different buckets. So for example, we'll use the long-term rental. You buy a rental property. When you buy that property, you're buying the land, you're buying the walls, the structure, but you're also buying all the appliances. You're buying the countertops. You're buying the flooring. You're buying the mulch out front. You're buying the grass. All those things that I mentioned, they don't last 27 and a half years. And the IRS actually has a book that tells you how long each of those assets last. So carpet is a 5-year asset. And I shouldn't say how long it lasts because there's stuff that doesn't make any sense. Like a roof is a 27 and a half year asset, but most roofs don't last 27. It's just these categories that the IRS places these things into. Your landscaping, for example, if you plant a tree out front, that tree is a 15-year asset. Well, that tree is obviously going to last a lot longer than 15 years if you water it and take care of it. But those are just the buckets that the IRS has approved. So we go in and we say, okay, we'll use that same example, your $275,000 purchase price, $12,000 of that was for carpet, $8,000 of that was for appliances, $28,000 of that was for the concrete out front in your driveway. So we segregate the cost into different buckets, and that allows you to depreciate it at a faster rate because now we're taking our carpet and whatever that $12,000 carpet is, we're depreciating that $12,000 over 5 years versus spreading out that $12,000 over 27 and a half. So at the end of the day, if you own your property for 27 and a half years, you're getting the same amount of depreciation. We're just front loading it into those early years. And again, there's a number of reasons why you want to do that. There's time value of money, there's inflation, there's, you're not going to own the property for 27 and a half years. So give me my deductions now versus letting the IRS hold on to them over the course of 27 and a half years or 39 years for.
Yeah. That's always a good reason to do something, let me have my money instead of the government.
Right.
I think most people investing in commercial real estate can agree with that statement. But
take that that tax savings, go reinvest it in a new property, pay down your debt. There's a number of things you can do with that money. So you got it.